You ever look at a price chart and just feel like it's speaking a completely different language? Well, today, we're going to learn a key part of that language. We're talking about fair value gaps, or FVGs. And trust me, these aren't just empty spaces on your screen. They're actually powerful clues that can hint at where the market wants to go next.
I mean, that's the dream, right? To have the chart just whisper its next move to you? And the crazy thing is, in a way, it kind of does. Once you understand fair value gaps, you can start to decode the story the market is telling you and maybe get a little sneak peek at the next chapter.
Okay, so here's our game plan. We're going to start with the absolute basics. What even are FVGs? Then we'll build on that with 3 simple rules to find the really good ones. After that, we'll get into fine-tuning our entries, talk about the crucial role of liquidity, learn when to just stay out of the market, and finally, we'll wrap it all up with a super simple, powerful checklist you can use.
All right, let's dive into section 1. What are fair value gaps? Think of this part as the blueprint. Before you can build any kind of strategy, you've got to understand the core idea behind it all, and that's market balance.
See, the market is always trying to find a balance between buyers and sellers. But every now and then, price moves so fast and so hard in one direction that it leaves this inefficiency behind, an imbalance. And that's what an FVG is. It's a 3-candle pattern that screams one side was completely in charge. Now here's the kicker. Price often feels the need to come back to this area to rebalance things before it continues on its way.
So, naturally, we've got 2 flavors here. A bullish FVG gets created by a powerful move up. It leaves behind a gap that acts like a support magnet, kind of pulling price back down into it before hopefully bouncing higher. In a bearish FVG, you guessed it, it's the exact opposite. A huge drop creates a gap that becomes a resistance magnet, a place where price might pull back to before dropping even further.
Okay, so now you know what they look like. But here's a lesson that's absolutely crucial. Not all FVGs are created equal, not by a long shot. So that brings us to our foundation, the 3 non-negotiable rules for spotting only the highest quality setups.
Think of these 3 steps as your ultimate filter. They're going to help you cut through all the noise on the chart and zero in on the FVGs that actually give you the best chance of success. Let's break down each one.
All right, rule number 1 is so simple, but wow, is it powerful. Always, always trade with the trend. If the market is clearly pushing up, making higher highs and higher lows, you should only be looking for bullish FVGs to get in on a long trade. And if it's trending down, you guessed it, you focus only on bearish FVGs for shorts. Don't try to swim against the current.
Rule number 2, we want to avoid used gaps. So if price has already come back and dipped its toe into an FVG, even just a tiny bit, we call that mitigated. It's basically already done its job of rebalancing. That makes it way weaker and a lot less reliable for a future trade. What we're really hunting for are those fresh, untouched gaps. And rule number 3 is all about getting the best possible price. So for a bullish move up, you can measure it from the low to the high. The whole area below the halfway point, the 50% mark, we call that the discount zone. That's where you want to find your bullish FVG. For a bearish move, it's the opposite. The area above the 50% mark is the premium zone. It really just boils down to buying low and selling high, but with a clear system. Okay, so we've got our foundation set. Now it's time for the fine-tuning. These next couple of techniques are a little more advanced, and they're all about helping you pinpoint your entry with, well, surgical precision. Now this is where it gets really cool. You can actually stack the probabilities in your favor. Let's say you spot a huge FVG on the 4-hour chart. I mean, that's a massive zone, right? Instead of just guessing where to get in, you can zoom into a lower time frame, maybe the 15-minute chart. And if you can find a smaller, more refined FVG hiding inside that bigger one, well, you've just found a super high confidence entry with a much smaller risk. You also need to pay really close attention to that 3rd candle, the one that completes the FVG pattern. If that 3rd candle is another big, strong candle pushing in the same direction, we call that a breakaway gap. That's a beautiful thing to see. But if that 3rd candle is weak, or worse, if it shows rejection from the other side, that's a rejection gap. And that, my friends, is a major red flag that the move might be running out of gas already.
Okay, now for the concept that ties this whole thing together, liquidity. If FVGs are the path, then liquidity pools are the destination. Understanding how these two interact, well, it's like learning to read the market's footprints, and it's what separates the okay setups from the truly great ones. So here's the core idea you need to get. The market is basically always moving from one pool of liquidity to another. And what are those pools? They're just old swing highs and swing lows.
Fair value gaps act like the internal fuel stations that price uses along the way to get to its external destination. Now, this leads to two totally different but really important scenarios. On one hand, you've got a liquidity run. This is when price just smashes through an old high with real strength. An FVG that forms during a run like that is an incredibly strong sign that the trend is going to keep going. But, on the other hand, you have a liquidity sweep. This is where price just kind of pokes its head above an old high and then gets slapped right back down. That is a sign of weakness, and any FVG formed there should be ignored because a reversal is probably coming.
You know, just as important as knowing when to trade is knowing when not to trade. So let's talk about the red flags, the warning signs that tell you to just stay on the sidelines and protect your money.
Look, the market doesn't always trend nicely. Sometimes it gets choppy, it goes sideways, and it enters consolidation. And when that happens, FVG strategies can get you into trouble. The biggest warning sign? You see a perfect-looking bullish FVG form, and then it just fails. Then a little later, a bearish one forms, and it fails too. When the market can't make up its mind like that, the best action you can take is no action. Just stay out until it proves its direction again.
Wow. Okay, we have covered a lot of ground. So let's bring it all together into a really simple, actionable takeaway, your very own FVG trading checklist. So before you even think about pulling the trade on a trade, you've got to run it through this quick test. First up, is it going with the overall trend? Check. Is the gap fresh and untouched? Check. Is it in a premium zone for a short or a discount zone for a long? Check. Is it a strong breakaway gap? Check. Did it form right after a clear liquidity run? Check. And finally, is the market trending cleanly, not just chopping around? Check. If you can tick all those boxes, you might just have an A+ setup on your hands.
So, there you have it. You now have the blueprint to see the market in a totally new way, not as just random noise, but as a story of balance and imbalance. These gaps, they're the clues that the big players leave behind. So the only question left is, now that you can see them, what are you going to do about it?